Management claims Singapore retail strength offset their overseas headwinds, but they buried a 9.2% valuation wipeout and a Japan portfolio that is currently sitting half empty. If you rely on MPACT Pan Asia Commercial Trust for your retirement income, this operational drag directly threatens your CPF and SRS dividend sanctuary. I have been watching this one for a while. The number that finally made me sit up was the gearing figure, and when I ran the full audit, I had to go back and check the data a second time. The scale of the overseas valuation wipeout was not what I expected from a trust this size. So let us move past the glossy cover page and look at what the real numbers are actually saying. The official management narrative is that Singapore retail strength successfully offsets any overseas headwinds. That is the story being sold to the retail investor, but the forensic reality tells a much harsher story. Hidden deep within the earnings presentation is a 9.2% valuation wipeout across their foreign properties, with gearing pushing 36.5%. This is no longer an academic balance sheet exercise. It is a direct threat to the CPF and SRS dividend income you depend on for retirement. Let us see how this translates into the actual cash you receive. Let us start with the number that actually pays your bills. The distribution per unit is the cash deposited into your brokerage account at the end of the quarter. The raw data shows a reported distribution per unit of 1.90 Singapore cents for the fourth quarter of financial year 2025 to 2026. That is a 2.6% contraction compared to the prior year, breaking their own 3-year average of stable growth. For context, CapitaLand Integrated Commercial Trust grew their distribution per unit by 6.4% over the same period. If you hold 50,000 Singapore dollars of this REIT, your annual income gain is a mere $2.46. That barely covers a single cup of kopi at the hawker center. Let us examine the debt taking this toll. Now we look at the gearing ratio. Gearing measures the percentage of the portfolio funded by bank debt rather than your equity. The balance sheet shows MPACT Pan Asia Commercial Trust sitting at 36.5%. That completely breaches our strict 35% safety ceiling and their own historical averages. While CapitaLand Integrated Commercial Trust sits higher at 38.5%, both entities fail the absolute safety test for conservative heartland investors. If property valuations drop by another 10% due to commercial real estate weakness, this gearing ratio will mechanically spike toward 40%. For a Singaporean managing a retirement portfolio, that means your capital carries a real risk of sudden equity fundraising that dilutes your future payouts. Let us look at how easily they can pay their interest bills. The interest coverage ratio tells us exactly how many times the company can cover its interest bills using pure operational cash flow. The raw figure here is a dangerously thin 3.2 times. That fails our strict fortress standard of 4.0 times entirely. In a stress test scenario, if the SORA benchmark rises by just 100 basis points, this ratio drops to a highly dangerous 2.4 times. For the heartland investor holding this counter for stability, a falling ratio means the REIT is literally one economic shock away from cutting your dividends just to pay their bankers. We need to look at exactly where this cash is bleeding from. The China property segment is showing severe distress. The raw fact is a brutal negative 21.3% rental reversion alongside a declining committed occupancy of 83.9%. This is among the worst performances across Singapore-listed peers. Historically, this cluster provided steady growth. Now it poses a massive forward risk. If the macroeconomic environment does not recover, this trend will bleed another 10% of the local net property income. Every time a lease is renewed at these lower rates, the rental income funding your dividends actively shrinks. You are holding an asset that is contracting in value. Let us review the lease expiry profile next. We also need to look at the weighted average lease expiry, the time left before tenants can pack up and leave. The retail portfolio has a very short lease expiry of 1.8 years. The office sector sits at 2.9 years. Short leases are excellent in a booming economy where you can quickly raise rents. In a downturn, they are terrifying. Tenants can easily renegotiate lower rates or simply walk away. For your wallet, shorter leases mean less income visibility and higher turnover risk. That level of uncertainty turns your supposed sanctuary asset into a speculative trade. Let us address the most alarming operational gap in the entire portfolio. There is one metric management spent the least time discussing. The Japan portfolio saw its committed occupancy plunge to 57.1% following the exit of a major tenant. During the presentation, this was brushed off in a single sentence. Management claimed the pressure was substantially behind them. Running a commercial building half empty means you are bleeding cash on utilities, maintenance, and property taxes with zero rental income to offset it. When management avoids talking about half-empty buildings, they are hoping you only look at the Singapore performance. Do not fall for the distraction. Let us compare this reality to the market price. The current verified market price sits at $1.34, trading on heavy volume of nearly 20 million units and down 4.2% post-results. The Investing Pro fair value model, which looks purely at cash flows and underlying asset strength, places the true worth at $1.40. The difference exposes a 9.2% operational valuation decline in their overseas properties, effectively wiping 602.9 million Singapore dollars off the books. We need to examine why this gap exists. This creates a specific forensic gap between the institutional market price and the intrinsic worth. The stock is currently trading at a 4.4% discount to book value. A discount might sound appealing, but institutional money prices assets below intrinsic worth for a very specific reason. The management guidance diverges sharply from the reality of that 602.9 million Singapore dollar overseas valuation loss. A discount is not always a hidden bargain. Sometimes it is a warning sign that the market sees structural risks the presentation slides are trying to hide. Think of buying a resale HDB flat where the lift upgrade program is only halfway done. The official valuer prices the flat based on the completed lift being fully operational. That is your theoretical fair value. But if the main contractor goes bankrupt and the lift lobby is left as a hazardous mess, the price a buyer is willing to pay today drops significantly. Mapletree Pan Asia Commercial Trust is sitting with a messy lobby in Japan and China right now. The theoretical fair value reflects the completed project. The current market price reflects the reality on the ground. Let us see how institutions are modeling this mess. The CLSA analyst note maintained a hold rating with a target of $1.35. Their reasoning mirrors our own exactly. Their valuation model assumes zero capital appreciation from the Lufthansa and Zhangjiang assets over the next 24 months. They highlight an 8.5% local currency valuation drop at Gateway Plaza as corporate occupiers shift to cheaper submarkets. When a major institutional house models zero growth, it signals that the geographic growth premium is permanently gone. If you hold this counter for capital appreciation, the math suggests you are looking in the wrong sector entirely. Let us evaluate the true cost of holding this risk. Finding new corporate tenants to backfill the 42.9% vacancy in Chiba City, where average rent growth is a stagnant 0.1%, will require massive cash, incentives, and significant time. For the retail investor, every cent of this discount represents a cent of operational risk absorbed directly into your personal retirement portfolio. The institutional signal is clear. With over 19 million shares traded on results day, the big players are selling, not buying. Let us calculate the exact yield spread. The current trailing dividend yield sits at 5.69%. We subtract the verified 6-month T-bill rate of 1.440% based on the April 2026 auction to find the pure risk premium. That gives us a risk premium of 4.29%, 429 basis points. This spread is the direct mathematical compensation for taking on the heavy balance sheet risk from those overseas properties. We now need to test this against our safety floor to see if it is enough. My forensic floor remains anchored at 3.2%. The minimum yield hurdle must be 4.7%, including 150 basis points of mandatory risk premium. Our standards do not move with the market. We audit for the storm, not just the sunny day. The forensic verdict here is mixed and precarious. The Singapore retail assets perform well, but the heavy overseas drag is systematically pulling down the overall distribution quality. Let us review the complete income scorecard. The distribution per unit failed its benchmark, contracting 2.6% to 1.90 cents. Net property income also failed, dropping 5.9% to 159.6 million Singapore dollars, while the dividend yield of 5.69% and the retail reversion technically pass our benchmarks. The core cash generation engine is visibly sputtering. Every figure here is drawn directly from the financial statements. The overall income is deteriorating. Let us look at the debt table next. The forensic verdict on debt health is highly concerning. Gearing fails our threshold at 36.5%. Net debt sits at 5,556.7 million Singapore dollars. The interest coverage ratio of 3.2 times also fails our 4.0 benchmark. 36.5% gearing combined with weak coverage means your capital is not in a sanctuary. It is heavily exposed to macroeconomic conditions and entirely dependent on management executing a flawless turnaround. Let us see how this impacts underlying asset value. The net asset value per unit has eroded from $1.78 down to $1.73 year on year. This capital destruction was driven primarily by a 301.1 million Singapore dollar foreign exchange impact and overseas valuation losses. This creates a dangerous scissor effect. The massive debt load stays exactly the same while the asset value supporting that debt shrink. That pushes the gearing ratio relentlessly higher even if management does not borrow a single extra dollar. Let us look at the upcoming debt maturity wall. The most pressing hidden danger is the 2027 debt wall. While only 9% of total debt matures this current year, a massive 19% totaling 1,083 million Singapore dollars comes due in the next financial year. Refinancing over $1 billion in a potentially higher SORA environment is a massive headwind. It will mechanically compress the cash available for your quarterly distribution, directly threatening your retirement income stream. We need to run these risks through our scenario analysis. In the bear case, if the Chiba vacancy persists past 6 months, the interest coverage ratio drops below 3.0 times, resulting in an estimated $200 cut per $50,000 invested. In the base case, assuming gradual Japan backfilling, the distribution remains flat, meaning your purchasing power actively erodes against inflation. Only in the bull case, where China valuations recover fully, does gearing fall below 35% to provide capital appreciation. The current macroeconomic climate makes the bull case highly improbable, heavily weighting the risk toward further purchasing power erosion. Let us examine the currency exposure. 24.9% of their debt is unhedged and exposed to SORA volatility, currently sitting at 0.986%. Only 80% of their income is in Singapore dollars, leaving them heavily exposed to the depreciation of the Japanese yen and Chinese yuan. When foreign tenants pay rent in weaker currencies, those rents translate to fewer Singapore dollars in your dividend check. While management uses hedging to delay this pain, that insurance is expensive. The deeper the North Asian currency pressure, the more it costs the REIT to protect your distributions. Let us review management's track record. Management previously projected strong synergies and stable occupancies following their merger. The actual outcome has been a chronic drag from Greater China and Japan, culminating in a 9.2% overseas valuation decline. Management has consistently underestimated the deep structural weakness in their foreign commercial assets. At the same time, they have over-relied on VivoCity to mask the overall corporate bleeding. This track record makes it extremely difficult to trust the current optimistic turnaround timeline. This brings us to a final insight. The forensic verdict on management credibility is decisively negative. They told retail investors that geographic diversification would protect the yield. The hard data proves exactly the opposite. The 21.3% negative rental reversion in China and the 15.8% drop in Japan net property income prove that overseas expansion has become a heavy anchor, dragging down the stellar performance of their Singapore assets. When the public story changes quietly but the balance sheet suffers loudly, stop listening to the presentation slides. Trust the math. Let us talk about how you can stay ahead of these numbers. In this market, the line between a safe sanctuary and a dangerous yield trap is often decided in a single trading session. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next market setup together in real time, dissecting balance sheets, modeling debt walls, and tracking institutional selling pressure before the mainstream media publishes their summaries. Finding the red flags early is the only way to protect your capital. For just 9 Singapore dollars a month, you get 0-day breakdowns, the complete red zone watch list, and institutional-grade cheat sheets built around the exact same 5-layer audit you see here. Stop being the exit liquidity for institutional funds and start being the analyst. Link is in the description. The single most important takeaway from this audit is this. Mapletree Pan Asia Commercial Trust is currently operating as 2 completely different entities, forcibly chained into one stock ticker. You have a world-class Singapore retail portfolio being actively suffocated by a deteriorating, capital-intensive North Asian office portfolio. Our forensic classification places this firmly as a watchlist trigger. It completely fails the transition and drawdown suitability tests. Accumulation is strictly conditional. The 36.5% gearing and the weak 3.2 times interest coverage ratio are the financial symptoms. The overseas property exposure is the underlying disease. The immediate risk is clear. The massive valuation wipeout and rising debt load prove this REIT is actively burning capital in foreign markets while leaning entirely on its Singapore assets to survive. Are you willing to sacrifice the long-term safety of your hard-earned retirement income just to subsidize half-empty office buildings in Japan? I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. The 7-day embargo window is actively running. Click the link in the description to join Iggy's elite investors and secure your retirement capital before the market moves against you. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.